Hey everyone, welcome to another podcast episode of From Worry to Wealth. I'm your host, Ben Lyons, and I'm here with my esteemed partner and business partner, I should say, right?
Yes.
And co-host,
Yep.
Mr. Alex Fink.
Well,
Take a bow, Alex.
thank you.
And in this podcast episode, we are going to talk about really a cool subject, which is market cycles. And we're going to dig into what a market cycle is, the benefits of market cycles, the risks of market cycles. We're going to talk about Warren Buffett's great quote. We'll save that quote for later. Anyway, with that, we'll see you in the podcast. So, Alex, in this episode, we're going to be discussing market cycles.
Which is exciting.
Very exciting.
Yes.
Okay, we're not talking about bicycles.
It can be depressing.
Not bicycles, but market cycles.
Got it.
Not a unicycle, not a tricycle, but market cycles.
Market cycles. Got it.
Is that funny?
I think it is.
The listeners, viewers may find that funny.
Bicycles are,
Maybe it's not that funny.
Yeah.
Yes, so we're talking about market cycles.
Cycles.
So let's first educate for our listeners and viewers what we mean, you and I mean, about market cycles. I mean, anyone knows what a market cycle is. But, basically we're talking about when things expand or contract, and the typical cycle of the expansion of the economy and the contraction of the economy, and what drives those cycles. A lot of times when you see the top of the cycle, they call that a bubble, right?
Yes.
Okay. Often we go through recession when we see contraction.
Yeah.
Now, we saw in 2008, so let's start with, one of the most recent ones for us. Now, COVID also created one. We'll talk about that in a minute.
Right. Tariffs created a little bit of a mini cycle. Yeah.
That's true.
Yep.
So let's talk about like the financial meltdown of 2007 and 8. And that created like this.
Do we have a therapist here for this? Because we may need a...
Probably.
Okay, because I might need to lay down for this one.
Well, I think in a previous episode, we talked about how painful it was for both of us.
We did, yeah.
But the market went through just a cliff, right? Financial catastrophe. Now, that wasn't driven by necessarily monetary or fiscal policy. That was driven by stupid lending. And maybe that had to do with
low interest rates. As interest rates started to increase, the house of cards were revealed, right? Bets on bets on bets. It was over leveraged based on a set of standards that were incorrect.
So let's start with that market cycle was created by underwriting standards, probably lending standards of most of the largest banks and non-banks in the world.
Right.
Okay, and that created this crash. So the cycle downward created a tremendous opportunity.
Huge.
So a lot of people lost a lot of money.
Right.
But this cycle downward, people who jumped in. So let's start with, in this podcast, a Warren Buffett quote. One of the most famous ever. Pretty sure it was he who said this. Be fearful when others are greedy, and be greedy when others are fearful.
Which is
You got that?
Very, very true words. Yes.
So in a market cycle, when we see contraction happening and we see pain and suffering happens, we like to run into the burning building.
We do.
And the key, I think, to a lot of people in trying to time things, whether you're timing the stock market cycles or bonds or real estate or commodities, I mean, it's not easy to do. So this isn't necessarily about market timing, this discussion in this podcast episode, but it is somewhat about market timing.
I think awareness, right? An awareness of when you have a market that makes no sense. If price to earning ratios are super high, right? If valuations are super high. If you look at a piece of real estate and it makes no sense because you could rent that piece of real estate for a third of what you'd pay if you buy it. Those things are tells, and that awareness informs decision making. And then it's a matter of having the the emotional intelligence to constrain yourself from jumping on the foolish bandwagon and getting yourself overextended.
Don't they call that the herd mentality?
Yeah, the herd mentality. That's exactly right. And then you have this contagion effect, right? Another herd mentality on the way down. So if you just avoid that, don't go with the herd, I think is a good lesson there.
Unless you're a sheep herder.
That's well, then you have
Or
to
a cattle
protect.
rancher.
You have to protect the
You
herd.
gotta
That's
deal with the
true.
herd.
Yeah, good movie, City Slickers, about that. You could.
Okay, that's good.
Yeah, long time ago.
I'll make sure I watch that.
Yeah.
But that really has nothing to do with market cycles. The
No,
herd.
it does not.
The herd in that particular movie.
In that particular movie, that's correct.
So let's move off of the 2008 financial collapse and let's look at what happened. The event of COVID,
Right.
right?
Mm-hmm.
What happened? What did that do? It created, right?
Yes. And I think what's interesting about these market cycles is if you have the herd mentality where you're jumping in, what we would propose is to be much more conservative as people are much less conservative, and be much more aggressive as people are much more conservative. And as it relates to COVID, this was almost an artificial bubble, right? It was no financial policy created that problem, right? So it was completely unexpected, and that's an interesting one to talk about, right? Because it's one that you really couldn't see coming. And I think, more recently, the tariff situation was another thing that caught people, off guard. But what's interesting about that is if you are positioned well, meaning you're not living paycheck to paycheck, or you have some cushion, which is what we would, argue that people should do, is have some, take their disposable income, save that income, right? Not spend everything that you make. Then you can, and I think that's the first step, right? Is then you can position yourself to take advantage of those things. And as values get really exciting, so people like us get excited about those downturns, right? And you jumped in to a lot more of the stock market during that time. I missed the window a little bit more than you did, which is very upsetting to me. But I think, if you can get on the right side of a cycle and you can recognize those cycles exist, then you can position yourself to take advantage of that. And some of our mentors in the program, some of our folks that we've interviewed, right? They have, one of the things that you'll note about those folks is that they've taken advantage of the market cycles. They become much more conservative, just like we do, when people are totally out of control and thinking the gravy train's going to run forever. And then after that downturn, we become much more aggressive, which is what we'd recommend.
Yeah. So Warren Buffett's quote, I think it's Warren Buffett's quote, be aggressive, be greedy when others are fearful. And what happened in COVID, the monetary and fiscal policy, they printed a lot of money, right?
They sure did after.
Okay.
After, yeah.
That was the reaction to COVID because nobody knew the effects of
Right.
of people getting COVID. Nobody could work. So
Right.
The Federal Reserve printed a ton of money.
Right.
And all of this money, they also, both monetary and fiscal policy actions were implemented. Interest rates were pushed down, right? Quantitative easing.
To the tune of about, what, $5 trillion?
Some very large number. And what did that do to asset prices?
Inflated them.
It inflated them.
Big time.
So money costing nothing allowed everyone to jump in to own assets.
Right.
And those people that were already in assets, it was great because you could refinance higher debt to lower debt.
Right.
You could acquire more assets.
Free money.
It was basically free money. Then all of a sudden, inflation kicked in.
Right.
Prices rose so fast, so far. Federal Reserve steps in and jacks up short-term rates.
Right.
The long-term rate, 10-year Treasury, all goes up.
Right.
All of a sudden, the goal is to put the brakes. But the business cycles, the businesses that were believing they had cheap money or could overpay for the asset,
right,
were screwed.
Big time. Yeah, anybody's plans that they made during that time dramatically changed as interest rates went up.
So for our viewers and listeners listening, the key and why be part of our Wealth Creators Institute is that we're not going to teach you to time markets. We're not that good. I'm not that good.
Nobody's that good.
We are going to create this awareness and an understanding of being intentionally aware of what's going on and hopefully take advantage of it.
Right.
Sometimes luck does happen when preparedness meets opportunity.
Right.
And the goal here is to be prepared. So for our listeners and viewers, what are you and I doing now? Because we have been predicting that if interest rates didn't fall in 2025, we were going to see a lot of defaults.
Right.
In certain areas of assets.
And a lot of people thought interest rates would fall in 2024.
They did.
Right. So what we're doing is we're taking advantage of that by going out and acquiring assets at a discount because of the pain that people are feeling right now, given the length of interest rates being high. Nobody predicted, there are very few people predicted that. Certainly not the people that got in assets. You got loans resetting. You have a lot of acquisitions that just simply don't make sense. Valuations are much lower today because interest rates are higher. So if you can time that well and take advantage of that and make choices that make sense even at the higher interest rates, it's only upside if interest rates go down, and that's taking advantage of the market cycle.
Yeah, so we can't go into too much detail again because we're involved in a lot of regulated businesses, so we've got to keep this somewhat generic. But you and I have been buying real estate that are all defaulted real estate.
For sure.
And we've been buying the debt and the real estate.
Right.
Okay, 50 cents on the dollar.
Yeah, sometimes less.
Sometimes less.
Yep.
And that only happens in market cycle downturns, in times of shifting markets.
Right.
And I think for our listeners and viewers, this is really great stuff to learn. And I would say most wealthy people make money when the wind blows in their face. So I'll go back.
That's exactly right.
I'll go back to when I was 19. And I met a private lender, very wealthy guy. In fact, he owned a whole bunch of businesses, but he was probably 75 when I was 19. I'm sure he's not around anymore.
Probably
that would make him a lot.
Yeah, yeah, exactly.
And
I think that would make him about 167 or something right now, based on your current age. Is that right?
Thank you. Yes.
Yeah. Go ahead.
But he was a private lender, and as you know, I was in the lending business and real estate business at that age, and he would lend money on deals. And one time he made a statement to me that has stuck with me forever. And he said, Ben, the wind always blows. Sometimes it blows at your back, and if it's blowing at your back hard, you can run like the wind.
Right.
And other times it blows in your face. And the key is just move the sail. I never forgot that.
Interesting. Yeah.
So market cycles to me is the wind at our back, low interest rates.
Not surprising you have a sailing reference in Maryland, right?
Yeah. Well, the guy, I think he was a sailor.
Yeah, he must have been. Yeah, exactly.
But that analogy stuck with me, and has stuck with me forever. And I think the idea of being conscious of the market cycle, and really, I think there are secular cycles. So there's broad cycles, gross economic cycles. There's also geographic cycles.
Mm-hmm.
And, cycles are really something that we like to teach at the Wealth Creators Institute. I don't think we can predict the future for sure, but we can look at attributes of the market. This is broadly speaking.
Fundamentals.
Look
at the fundamentals. Absolutely.
And we can help our investors navigate what's ahead.
Right.
So what else can we talk about? Let's kind of come up with some definitions just for our listeners and viewers so that they clearly understand when we talk about a cycle. Ray Dalio does a tremendous job of talking about economic cycles. So let's kind of talk about what that curve looks like. What are the attributes of the curve? There's the peak.
Yeah.
The peak is the bubble.
Yep.
The peak is the height.
Yep.
And then the opposite of the peak would be
there's always resistance to the upturn. And I think there's resistance to the downturn. And that resistance is a window that offers some telling science where, the herd mentality is still kind of running with the herd. And I think people naturally, they're hopeful, right? So they want to hope that things aren't as bad as they seem. And that's where you can really get stuck, right? When you get at the top of the cycle and you just go all in on something. And it's an interesting, so there's a lot of psychology that plays into the cycles.
There is. And in lending, I would say if you go back, I started my career in 1983, savings and loan crisis was really fired up then.
Yeah.
And I learned a lot from the older people that told me about what led up to the savings and loan crisis. And then you had the dot-com bubble, right?
Yep.
Think about that, leading up to 2000.
One of our mentors rode that pretty well.
Yeah.
Yeah.
I mean, right. One of our mentors exited really well.
Yeah.
And then all of a sudden, a year later, that company was worthless.
Right. Exactly.
So understanding cycles and what to do with them is really...
And also the fundamentals, right? I mean, our mentor, one of the mentors in the program, and our investor, understood, right? The fundamentals just didn't make sense at all. And that was the tell for him to say, I'm getting out. And it worked out really well for him.
Exactly.
And this resistance to change, you'll see in, the mortgage meltdown, right? And some of that resistance to change was everybody repositioning, the major institutions repositioning themselves to start going after the troubled assets, right? And acquiring assets at a discount to mitigate their losses on the other side. It's a really interesting thing to watch.
It is.
Yeah.
So on one hand, they're making the asset and making money,
selling it to the public.
Selling it to the public.
Right.
Passing
and at the same time, creating a department that buys that thing at a discount later and offsets their losses the entire way. Yeah.
It's fascinating.
It is. It is. Yeah.
So there is a way to make money when the wind is at your back.
Yes.
And there is a way to make money when the wind is in your face.
Yeah. And I think you would agree. And I've said this many, many times. I get super freaked out when everything's going great and when everybody's excited. I get very, very nervous. And I'm sure you feel the same way.
Yeah.
But when things are horrible and everybody's unhappy and everybody's scared, I kind of like it. It's kind of my wheelhouse. I like it because, as I tell people, and you mentioned this earlier in the episode today, that's generally where wealthy people make all their money. And certainly I think it's true for you and I.
Yeah. If you can buy at a discount. So in the stock market, they call that value. I think we've talked about this in the previous podcast episode. There's the creation of value, which is when the wind is at your back.
Right.
I'm sorry. There's riding growth, which is when the wind is at your back. And then the creation of value.
Yeah.
And value for me, value investing in the real estate world or in the debt world. You and I like to play in debt instruments.
Yeah, for sure.
It's buying, and I guess we could publicly say this. I just can't give any names, but you and I are fundamentally under a contract to buy $11 million mortgage for $5.3 million.
Mm-hmm.
And we just bought a mortgage that had a balance of about $1.7 million.
Bought it for 1.1.
1.1 million.
Yeah.
So these are the value buying opportunities when you buy the dollar at a discount.
That's exactly right.
And for our listeners and viewers, this is really fun stuff, and it's fun to teach because if you can buy a dollar at a discount in a market cycle contraction, then you're less likely going to make a mistake whether that asset rises in its baseline value or not. But because you bought it correctly, you're fine.
And that's the fundamentals that we talk about too, right? Yeah. Because as market cycles change, those fundamentals change, and the terms that somebody enters into a relationship, as those terms change, the fundamentals are non-existent. And so to the extent you can buy an asset where the fundamentals make sense in the current market, as that market improves, it just becomes really, really accretive.
Yeah, well said. And again, let's reiterate for our listeners and viewers that we are not suggesting investors in the stock market and in the commodities market learn to time when to buy, when to sell. we're not going to give that advice, right?
Correct. Yeah.
But what we are going to teach is what are the things you can look for? What are the fundamentals? What are the attributes that allow you to identify
Right.
these markets and what they may tell you?
Yeah. And while you can't time the stock market, and nobody has successfully done that, even the smartest people, the folks from, if you've watched Ben, I know a movie that you and I both like, known as The Big Short.
Yes.
Right. If those guys could time, those guys knew exactly what was going to happen. But did they time that market well? No, because the lead investor in the shorting of that market was 3 years early.
That's right.
Right. And the amount of pain
Right.
and suffering so you and I were in that business. We did not do the same thing. We did not short that market. We took advantage of the market after that, but we didn't time it well. Right. And we were, part of that core business. And when I learned of that story, that these people shorted the market, made a ton of money, I was pretty pissed off. Right. But because I'm thinking, how did those guys do that and get there? Right. But then when you actually know the story of how they timed it and the pain that they felt, I walked away thinking those guys deserve everything that they got out of that. And that's part of the market timing, right, that we're talking about, because I think it was one of those same investors that were featured in that movie later was shorting Zillow, for example, and going on CNBC and all these programs. I don't know if you know this, but I'm sure you do. Was saying, Zillow's getting into the real estate market. They have no idea what they're doing. Their stock's going to go down, way down. And he was 2 years early on that. He shorted it, got killed on the short. And everything that he said was going to happen actually did happen, just not exactly when he thought it was going to happen. And he got a little bit killed on that short, right?
Yeah.
And so what I would say is, a recommendation we would have is, don't try to time the stock market. Put your money in the market for the long term, leverage that investment to then time market cycles. That's what I would recommend, right? And I've done that.
Yeah. And what's one stock close to home that I was talking about for years?
I don't even want to mention it out loud because I'm going to have to get the therapist in here.
Right.
Yeah.
Right. So after the 2 plane crashes,
Yeah, right.
So for our viewers and listeners,
Right.
You had the 2 plane crashes, then you had COVID. Boeing was trading in the 120s.
Right.
And I'm not, stock market's not my background in education, but you and I like to.
Yeah. Make investments in the market for sure.
Yeah. So I got it right. It just
100%. Yeah.
It just took 3 years.
And that's the thing. You're almost fighting the cycles at that point, right? You're trying to engineer an entry and exit there with a market that doesn't tend to operate on the timeline that correlates to the knowledge of an event, right? Just like the guys in The Big Short knew this was going to happen, said, I don't even understand. And then as things went bad, positions didn't change. And so sometimes the fundamentals aren't necessarily represented in the stock market as they should be.
I think they
right?
call those lead and lag indicators.
Yeah, exactly right. And so you could get killed, right, trying to time the stock market. We would not recommend that.
Yeah, we're not recommending timing, but I think we are recommending that our students, at least that are part of the Wealth Creators Institute, understand what market cycles are and that they exist and be intelligent about. And, one of the things I find very fascinating all the time, and I'm not trying to pick on so many people, because I would say, this is my opinion, 95% of our viewers and listeners, if I ask them about when the Federal Reserve talks about interest rates, they're thinking 30-year mortgages.
For sure.
And the Fed funds rate
is a short term.
Yeah.
Not at all correlated to a long-term word.
That's right. It's not directly correlated to long-term rates.
Yeah.
So it's really it's all awareness, right? It's all knowledge. And
I think the fear of missing out, right? You got this FOMO mentality, this contagion effect of investors where you hear it from enough people, you got to buy this, you got to buy crypto. When one of our friends and investors was pretty heavy into crypto and was very excited about crypto, and I think it was the Super Bowl where Tom Brady won the Super Bowl with Tampa Bay. I watched that Super Bowl, and there were more commercials advertising crypto than any other industry. And at the end of that, I called him and I said, "Get out now," because I said some very bad things happening. Those are tells, right? You have this rise, and then you start to market to the public, and you get. I mean, what are you targeting with that audience in a Super Bowl commercial? Young men, a lot of young men. I think the primary demographic watching that's 18 to 40-year-old men. Not the intelligent investor typically, right? And so so there's tells all over the place, but the fear of missing out got people in that. And I think crypto went down after the Super Bowl 80%, 70, 80%. And it's gone back up since, but that would be an opportunity, right? If you got out and wanted to get back in. I'm not a big fan of crypto investing myself. But that's another indicator, right? When you see things when you see just heavy advertising to a demographic that doesn't have a lot of wealth, and you try to get those people excited thinking they're going to be wealthy, usually that's a very, very bad sign. It's kind of like they say about your investor. When your 7-year-old cousin is buying tech stocks, it's time to get out of tech stocks, right?
Yeah. So as we wrap up this episode, what other information and advice, recommendation on market cycles would become valuable to our viewers and listeners that comes to mind? Do we have any last stories that we can talk about market cycle success stories? Maybe one that was a really, really good success. Probably Dolphin Shores had the makings for one of the best success stories.
For sure. Go ahead.
Yeah, well, that was a 2008 collapse, right?
Yeah.
That was a bank that went under.
Right.
Because of 2008, they were heavily invested in real estate.
Mm-hmm.
And I think the debt on that was a total of about $13 million. We came in at a $2.3 million bump mortgage.
Right.
What's that? 9 cents on the dollar?
Yeah.
No, that would
It's a little bit
be
more.
like 20 cents,
Yeah, 20.
18 cents on the dollar. And that property today, I mean, we don't own it anymore. We sold it, but that property today is probably worth 35 to 40 million.
Right.
Let it be a lesson to us, right?
Yeah, exactly.
So we bought it right.
Right.
We got out.
Got out a little too soon.
Got out way too soon.
Yeah.
That's on me. But
we've made many mistakes. That's why we're here.
But that asset, I think, if you look at my career of 41 years, and I say what one particular asset based on market cycle timing did I get in right that would have contributed the most had I held it
right
to its point.
Well, you have a series of houses too that you owned when you were younger. There's a lot of things that we've done. We've done some real estate projects together that we sold.
But this isn't about just normal of inflation and appreciation of assets. We're talking about.
Oh, true. You're talking about a cycle.
Where did we enter?
Yeah.
Where we entered so well.
Right.
That we just, boy, did we get it right.
Right.
And I think that was the one.
Yeah, I agree.
If not the one, it was certainly up top 3.
Right.
But that's where to be aware of.
Well, as we look back too, that's an example, right? Where when we look back, we're not thrilled with, even though our entry point was great and we had some success. I think you look back and say, well, man, I wish I hadn't have sold that asset. So,
to me, it was a failure because the entry point was brilliant on our part. I mean,
but there's many other deals like that where we've sold too quickly. Yes.
It was not being patient enough.
Right. For sure.
And 41 years of doing this and making mistakes really gives us, I mean, you've been doing this almost as long as me. You're not, just for the record, he's 10 years younger than me.
I didn't say it.
Okay. So 31 years. We still have the ability to educate our students on this topic of market cycles, really how to capitalize, not time, but really capitalize on these clues, fundamentals.
Yeah. And there's a risk tolerance there, right? You can de-risk yourself pretty quickly, but as I've seen other investors that I talk to that hold on just a little bit longer. And, when they're feeling pain. And in a lot of those cases, it seems to work out. Okay.
Well,
I'm sure you have
that's
some
advice.
stories, right?
Well, I'll use his name is Malcolm Berman, who
Right.
one of the wealthiest, people in Maryland.
Yeah.
Hopefully Malcolm's not upset for me to say that, but Malcolm, was one of the mentors and business partners when I was a younger pup. But I interviewed Malcolm when I was writing this book. I think he was 80, 86
Right.
when I interviewed him.
Oh, and I remember this quote that you're going to say.
I said, Malcolm, give me the one thing after all these, you're wildly successful. What
Right.
was the one thing that you wish you didn't do? And his answer was, I should never have sold anything.
Never have sold anything. That's exactly right. Yeah, I'm sure you feel the same way.
Yeah. Well, that's great advice.
It really is.
Yeah,
It's painful, though, when you're in the thick of it, right? When you're in the storm, it's painful.
It is painful.
Yeah.
All right. With that, we'll probably wrap this episode up. I appreciate everybody being with us in this episode of From Worry to Wealth. Please check out the website, Wealth Creators Institute. This is where you can get a lot of information from Alex and from me and all the mentors that are here to support this community. And we'll see you in the next podcast episode.